Good evening, Andrews stakeholders. Thank you for joining us. I hope everyone is having a pleasant evening. For anyone that is new to the group, my name is Peter, and we are from the company Business Analysis Logistic Division of Independent Nomads. But please call us Baldwin for short. It's a bit of a tongue twister. And we're here tonight to make your lives easier, as we have an in-depth analysis of how your company Andrews has performed in the past 8 years. First, please let me introduce you to my colleagues who are with me this evening. Running down our team, firstly, Amy is our head performance analyst. We have Bianca from our legal department. There is Stefan from our competitor analysis unit, and myself, operations manager. We come from a long line of business experts with decades of experience and knowledge. We've come to you this evening to give you an easy to understand report of how your company Andrews has performed within the 8 years since it was bought by its controlling company Microsoft. We shall dive into how the decisions of the managing partners over the last 8 years has led the company to where it stands today. I know you would all be interested into knowing how your investments are being put to use. We will touch on positive decisions, mistakes made by the group, any ethical issues that are or could be present, and finally, we shall be recommending strategies that will grow the business further and build on its already existing platform. Let us take a look at the past 8 years of operations to identify key decisions that has led to where Andrews sits today. In the first year, Andrews started by immediately spending big on plant improvements and marketing. As the graph shows, they were leading spender of plant improvements in the first year, with 31% spent more than its competitor Ferris. A new product AIM was also put into production to be ready for sale in the second year of trading. In the coming years, the group continued on a trend of plant improvements and high marketing spend for a couple of years. However, in 2023, they hit a bump in the road and recorded the company's first loss. We will discuss this in greater detail later, but wage negotiations resulted in a 54-day strike, which ultimately led to a loss for that fiscal year. In 2024, Andrews recovered well from the previous year and again returned to profit, as accessibility reached 100% or close to for each segment. Spend was reduced for the sales budget. 2024 was also the year TQM was introduced. Andrews invested $1.5 million in each initiative except for GRT, channel support effectiveness, benchmarking, and QFDE. It appears as though Andrews made the decision to not invest in these initiatives, as they either reduce administrative overheads or increase the effectiveness of the sales budget. And as Andrews had already reached 100% accessibility for each product, the reduction in spending is logical, as this funding could be focused in other departments. In 2025, Andrews paid a dividend on their stock for the first time. They also purchased extra stock and retired some long-term debt. By 2026, HR was up by 120% in productivity. Once again, the group decided to pay dividends again, pleasing to the stockholders, and retirement of current debts. They decreased TQM spend to $1 million for each investment previously invested in. The group invested $1.5 million in vendor, channel support effectiveness, benchmarking, and QFDE. The initiative is previously not invested in. This was with the intention of reaping exclusive benefits from these segments to create a market gap, but due to other companies also investing in these, no market advantage was seen. In the past 8 years, the company has recorded a cumulative profit of just under $77 million, the second highest compared to its competitors within the industry. The stock price is currently sitting at $106.26, once again, second in the industry only to Ferris. With this in mind, the company's figures show a positive performance result overall. I will hand over to Amy, our head performance analysis, to dive into how Andrews has been applying their strategy.
Thanks, Peter. Now we move on to look at Andrew's strategy. Andrew's strategy was to be a broad cost leader. A broad cost leader maintains a presence in all segments of the market, offering low-priced products to provide high value. A broad cost leader increases automation levels to improve margins and offset shift and overtime costs. Andrews have consistently focused on increasing automation with a high marketing spend, whilst keeping products mostly average in terms of development and price. Looking at this graph, you can see the automation levels of Andrews for each product has risen over the past 8 years. And if we compare this side by side with labour cost per product, it shows that as Andrews increased their automation levels, it helped to decrease their labour cost per product. Now, looking at mistakes by Andrews, we've identified 2 areas that mistakes have arisen. The first being labour negotiations, which caused some problems for Andrews as their starting position was too low. And next was the complement. 100% completion wasn't required and potential profit was lost here. The starting negotiation position for the first labour negotiations in 2023 was too low. This resulted in a 54-day strike and therefore a loss was recorded that year. They did recover quickly by making a profit the following year, and they mitigated this to some degree in 2025 by having a more generous starting position than previously. However, still suffered a 13-day strike. In both 2023 and 2025, Andrews missed the opportunity to impose higher costs on other companies. Due to their high automation and investments in TQM, they could have spared some cash and gone high with their starting negotiation position. This would have forced other companies to suffer a strike and higher costs, and therefore providing an advantage to Andrews. Profits could have been maximised by reducing completion. Completion is the number of workers required to fill the production schedule without overtime. 100% productivity means that the current workers are just as good as the original workers. Productivity at 120% means that, on average, only 83% of completion was required to do the same work. Essentially, the higher the productivity, the fewer the workers needed. Now, could analytics be the answer? HR analytics would assist with mitigating against both of the mistakes identified. HR analytics is an evidence-based approach which uses simple reporting of HR metrics through to predictive modelling to make better decisions on the people side of business. Accurately predicting future outcomes and making decisions based on those predictions can only be a benefit to the company. I'll now pass you on to Bianca, who will talk about ethical considerations.
Thank you, Amy. Andrews is a very matter-factual company which does not fully take personal feelings into consideration. It will do whatever is best for the company rather than caring for their employees, customers, or third parties. This can be seen by the 54-day strike that occurred. The 54-day strike happened because Andrew offered a too low price for the labor negotiation round, causing employees to go on strike and lower production. This even shows the ethical thinking that Andrews has. Andrew tried to pay the bare minimum as to benefit the company instead of paying their workers a fair wage. It can also be seen that Andrews tries to spend as little as possible where it is not required to spend a lot. This can be seen by the TQM spending. Spending of 1.5 million on every section, but the ones which will increase their production accessibility as it was already 100%. Andrews has also not invested in reducing administration as it was already very effective, but it shows that Andrews was not focused on their employees' welfare, but instead of whatever the company needed. Now on to the executive shake-up. At the end of the 4th year, the team at Andrews made an executive decision to remove one of its board members, Peter Schurman, and to hire Simone. This made a drastic change to how the company was performing. Let us take a closer look. So how did Andrews score after the shake-up? In this graph, you can see the overall score of each year of trading to date. As you can see, the scores after year 4 indicate that the company is performing better post-shake-up. The biggest change, as you can see in the graph, was in margin and profits. The scores of each trading year after shake-up are significantly improved. This is unlikely to be able to be contributed solely to the new staff member though. There has been a strong company strategy of spending big in marketing and automation. Borrow early to cover those costs and to reap the rewards later. The margin and the profits came from the early groundwork laid by Andrews. The score for the products also increased post-shake-up, as you can see above. The first 4 years were scored 18, 24, 25, and 26. The following 4 years were scored 28, 32, 32, and 31. It seemed likely that this change was brought on by the new member as large improvements of products doesn't necessarily fit into Andrews' company strategy. Also, prior to the shake-up, the scores were steady. There is clear difference in products before and after. The improvements to the products would have been clearly generated more sales and improved customer scores on each product. I will now pass you on to Stephen, who will talk about the competitor analysis and the recommendations for Andrews. Thank you.
Thank you, Bianca. Good afternoon. I'm here to explain the competitive analysis of the simulation activity performed on choice of company affairs. The major competitor is found to be Andrews. The profit calculated for fares is 529.27674, and for that of Andrews is 290.98075, which is closest to each other. Further, return on sales has been able to reveal a close competition between the two companies. The calculated ROS is 16% for fares and 12% for Andrews. It shows how efficiently the company has been turning its sales into profit. Further, calculate return on equity revealed to be 35% in case of fares and 34% in case of Andrews. ROE helps in measuring profitability of the company with respect to the equity. It defines increasing ability of the organization to generate profit, which is quite similar for both fares and Andrews. The calculated value return on asset is 70% for both Android and fares. It helps in defending the efficiency of the organization to use the underlying asset. It is similar in case of fares and Andrews. It can be stated that Andrews and fares are close competitors to each other. The simulation activity has been able to reveal that the best performing company considering all value aspects is fares. On the other hand, the company that is not able to perform effective and has constantly been facing decreased profit. ROE and ROA is Baldwin as compared to other functioning company of similar nature. In the end, it has been concluded that although fares has been performing effectively at the platform, a competitive threat in the form of Andrews has been present in the market. In order to cope up with this aspect, fares must concentrate on reducing variable costs of the company, which is current 186,603,780 as compared to Andrews, which is 136,428,868. Further, an increase in the ratio of debit and decreased equity can help in improving overall return on equity percentage. In the end, it has been suggested that the significant increase in sales and decreasing in expenses can help in improving the percentage of return on asset for fares and remain competitive in the market.
Thank you, Stefan. So what does this all mean? What should the stakeholder be interested in? Here are the main points you should take away from this. Andrews is performing well compared to its competitors, but it's not performing the best. The past 8 years of its performance has resulted in a respective cumulative profit and share price. After the executive shakeup, the company performance increased by almost doubling their profits and margin. The product scores have dramatically increased. This change in numbers was due to the change of strategy that the new member has provided. Ethically, it can be seen that Andrew tries not to pay their employees that much close to the bare minimum, as the 55-day strike occurred. It can also be seen that Andrew tries to spend as little as possible where it is not required to spend a lot, as seen with the TQM. The strategy was a broad cost leader with a focus on high automation and initial high marketing spend. Mistakes were going to be low with labor negotiations and filling completement 100%. This missed opportunity to inflict higher costs on other companies and to maximize profits themselves. Thank you for listening. Are there any questions?